wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 173, and in this episode we are reviewing the performance of the financial markets during the 33rd week of 2025, and that is from Monday the 11th to Friday the 15th of August. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the annual rate of inflation accelerated, but at a slightly slower pace than expected in the month of July, as President Trump's tariffs showed modest impact on consumer prices, and as investors grew more confident that the Fed would cut interest rates at its next policy meeting. According to the Bureau of Labor Statistics, the Consumer Price Index, which measures the change in prices for a selected basket of consumer goods, this increased by a seasonally adjusted rate of 2.7% on an annual basis, and this was slightly lower than the Dow Jones estimate for a rate of 2.8%. Excluding food and energy prices, the core consumer price index increased by 3.1% over the past 12 months. For your information, Federal Reserve officials generally consider core inflation to be a better indicator for longer-term inflation trends. This particular inflation report comes at a critical time for the economy, especially after President Trump fired the Commissioner for the Bureau of Labor Statistics on unproved accusations of manipulating the jobs data and raises questions about the ability of the Bureau to remain independent and trustworthy. According to the CME's FedWatch tool, traders are now pricing in about a 91% chance that the Federal Reserve will cut interest rates at its next policy meeting in September. Over to the People's Republic of China, where the Chinese economy lost momentum in the month of July, with growth faltering across the board as weak domestic demand persisted and as the government intensified efforts to curb excess capacity. Data from the National Bureau of Statistics showed that retail sales for the month of July rose by 3.7%, falling short of market expectations for a growth of 4.6%, and slowing down from a growth rate of 4.8% in the month of June. Meanwhile, industrial output rose by 5.7% in the month of July, which was the weakest growth since November 2024 and was also weaker than market expectations for a growth of 5.9%. The National Bureau of Statistics attributed the disappointing economic performance to the ongoing challenges resulting from an unprecedented external environment and extreme weather conditions. In the month of July, high temperatures as well as heavy rains and flooding hit several regions across the country, forcing factories and construction sites to suspend operations. Over to the Far East, where Japan's economy expanded at a faster than expected pace of 0.3% in the second quarter of 2025, compared to a growth rate of 0.1% in the first quarter, and outpacing economists' forecasts, as well as overcoming the unpredictable tariff policy from the United States. Japan's growth in the second quarter was mainly attributed to resilience in exports, which added 0.3 percentage points to the country's gross domestic product, and this was in contrast to a contraction of 0.8% in the first quarter of this year. On an annual basis, Japan's gross domestic product expanded by 1.2% in the second quarter of 2025, falling short of the first quarter's growth rate of 1.8%. Over to the United Kingdom, where, according to data from the Office for National Statistics, the UK economy expanded by a better-than-expected 0.3% in the second quarter of 2025, appearing to shake off the impact of US tariffs. Economists polled by Reuters had expected the country's gross domestic product to expand by just 0.1% in the second quarter, compared to a bumper growth of 0.7% in the first quarter of this year. After a strong start to the year, the UK economy took a breather in the second quarter, and according to economists, it is highly unlikely that this positive momentum will continue into the third quarter. This view is backed by a softening labor market and a limited production capacity, where even mild economic growth could generate inflationary pressures. With this in mind, the markets are projecting that the Bank of England will keep its policy rate on hold for the remainder of this year. On Wall Street this past week, it was a strong week for stocks, even though the S&P 500 slipped on Friday as investors took some gains off the table following the release of the latest consumer inflation data, which raised hopes that the Federal Reserve will cut interest rates at its next policy meeting in September. A decline in chip stocks and weak consumer sentiment data hurt the stock market as the University of Michigan's Consumer Sentiment Index declined in the month of August due to concerns about inflation. The three major averages remained on solid footing this week as the Dow Jones Industrial Average outperformed with an increase of 1.74% to close at 44,946, whilst the broad market index, that is the S&P 500, gained by 0.94% to settle at 6,449, and with the tech-heavy Nasdaq Composite rising by 0.81% to end the week at 21,622. In the government bond market, Treasury yields rose on Friday after the latest retail sales and consumer sentiment data provided contrasting views about the U.S. consumer. Retail sales rose by 0.5% in the month of July, indicating that consumers were reacting well to price changes. Meanwhile, the University of Michigan's Consumer Sentiment Index fell in the month of August, mainly due to concerns about inflation. However, in contrast to this data, the Consumer Price Index for July rose at a slower than expected rate of 2.7%, which helped to ease concerns about the impact that tariffs are having on consumer prices. According to the CME's FedWatch tool, the Fed Fund Futures is currently pricing in about a 91% chance that the Federal Reserve will cut interest rates at its September policy meeting. In response, the yield on the 2-year Treasury note added 2 basis points to close at 3.75%. Whilst the yield on the benchmark 10-year Treasury bond rose by 3 basis points to settle at 4.32%. In the commodity markets, the price of crude oil was down by about $1 a barrel on Friday as traders awaited the outcome of talks between President Trump and his Russian counterpart, Vladimir Putin, over the ongoing war in the Ukraine. President Trump has threatened to impose secondary sanctions on Russia if there is no progress with the peace talks. The president has also threatened to impose tariffs on India and China if they continue importing crude oil from Russia. For the week, the price of the global benchmark Brent crude eased off by 1.1% to settle at $65.85 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this dropped by 1.7% to close the week at $62.80 per barrel. In the precious metals market, the price of gold held steady on Friday but was headed for a weekly loss after the release of mixed economic data as the markets shifted focus to the Fed's upcoming policy meeting in September. Gold's bullish outlook remains intact, supported by a slowing global economy, mainly due to higher trade tariffs, plus the prospect of monetary policy easing in the U.S. that is driving the persistent weakness in the U.S. dollar. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold was down by 1.8% for the week and eventually closed at $3,336 per ounce. We now change scene to the Kenyan financial markets. And as usual, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained static versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24, which was the exact same rate that has been recorded for the past 2 weeks. Meanwhile, the sterling pound was priced at 174.49 and the euro was valued at 150.94. And on the regional front, one Kenya shilling was changing hands for 27.55 Ugandan shillings and 19.54 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.20. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, During the past week, Kenya's usable foreign exchange reserves increased by a massive $219 million for a grand total of $11.11 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. But despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. On diaspora remittances, the inflow of remittances to Kenya totaled to $410 million in the month of July 2025, compared to $414 million in July 2024, which was a decrease of about 1%. Meanwhile, the cumulative inflows for the 12 months to July 2025, these increased by about 11% to $5.08 billion, compared to $4.57 billion for a similar period in 2024. The consistent growth in remittances remains a key source of foreign exchange earnings and continues to support the country's current account position and provide stability to the domestic foreign exchange market. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this dropped from 9.6% the previous week down to 9.48%, which was in line with the revised central bank rate at 9.5%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 7.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 14th of August, and the central bank received bids totaling to 23.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 96%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate fell by 6.9 basis points, down to 8.01%, whilst the 182-day rate declined by 5.3 basis points to settle at 8.11%, and the 364-day rate tumbled by 13 basis points for a weighted average rate of 9.58%. In the primary bond market, the monthly Treasury bond auction was held on Wednesday, the 13th of August, And the central bank ended up receiving an astronomical amount of 323.4 billion shillings against an advertised amount of 90 billion shillings, representing a performance rate of 359%. The central bank ended up accepting only 95 billion shillings, and the results of the auction were as follows. For the first bond, which was a 15-year infrastructure bond that was initially issued in 2018 and now has 7.5 years left to maturity, the central bank accepted 50.6 billion shillings at a weighted average rate of 12.99% compared to the bond's coupon rate at 12.50%. And for the second bond, which was a 19-year infrastructure bond that was initially issued in 2022 and now has 15.6 years left to maturity, the central bank accepted 44.3 billion shillings at a weighted average rate of 13.99% compared to the bond's coupon rate at 12.96%. Please note, as is the norm with infrastructure bonds, the interest earned from these bonds is exempt from withholding tax. Up next is our topical issue, and this week we are looking at the Central Bank's Monetary Policy Committee, which held its meeting on Tuesday, the 12th of August, and during its deliberations, the committee made the following observations. According to the latest World Economic Outlook report by the IMF, the outlook for global economic growth in 2025 has been revised upwards from 2.8% to 3% flat, mainly reflecting upward revisions to growth in the United States and China. However, weak global demand due to trade tariffs and heightened geopolitical tensions in the Middle East and Ukraine remain a major risk to global economic growth. On the domestic scene, the GDP data for the first quarter of 2025 showed continued resilience of the Kenyan economy, with the real GDP growing by 4.9%, reflecting a robust performance from the agricultural sector and a recovery in construction. Meanwhile, Kenya's overall rate of inflation increased to 4.1% in July, up from 3.8% in June, as inflation remains below the central bank's midpoint target rate of 5%. On matters relating to trade, Kenya's current account deficit narrowed to 1.6% of the country's gross domestic product in the 12 months to June 2025 and is projected to remain relatively stable in 2025 and will be fully financed by inflows into the financial account. The committee noted that the banking sector remained stable and resilient with strong liquidity and capital adequacy ratios. However, the ratio of gross non-performing loans remained extremely high at 17.6%. The Monetary Policy Committee was also appraised of the revised risk-based credit pricing model that has been proposed for the banking sector and which is expected to improve the transmission of monetary policy. Meanwhile, the growth in lending to the private sector continued to remain weak at 3.3% in July 2025, as the average lending rate declined to 15.2%. Having considered these developments, the committee concluded that there was scope for further easing of monetary policy in order to augment the previous policy actions that were aimed at stimulating lending to the private sector and supporting economic activity, whilst at the same time ensuring that inflationary expectations remain firmly anchored and that the dollar-shilling exchange rate remains stable. The Monetary Policy Committee therefore decided to lower the central bank rate by 25 basis points from 9.75% down to 9.50%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, wealth that is gained hastily will dwindle, but whoever gathers little by little will increase it. That is Proverbs 13:11. Think about it. Thank you, and God bless.